But let's also get you some views on how you can approach the next 1 year. We have Credit Suisse's Neelkanth Mishra, who's very bullish on the banking space. No surprises there, but let's listen into his views on the market. We'll head into a short commercial break and be back with more.
The recovery from the pandemic is likely better than had been feared. And therefore, the pace at which the economy is operating right now is better than had been expected even 6 months back. The second is that from a medium-term perspective, there are several drivers of growth which did not exist or were much weaker in the previous cycles. So the most important being that the real estate inventory, the dwelling construction cycle is, I think, improving. I think the Indian participation in goods supply chains globally, there is a market share gain. So in electronics, in chemicals, in maybe even in apparel, in auto components. Now, the reason this matters is that even though the global goods supply chain is currently under a lot of stress, the market share gains are helping offset some of the impact even in the near term. And then you have significant improvements in infrastructure. So road freight is a lot easier to move now. And I think these kind of structural shifts matter a lot when you are thinking about the medium-term growth. But I think this bigger picture, are we going to be able to withstand a substantial global slowdown, is something that we should not overdo, in the sense that we will have an impact of the global goods slowdown. We are already seeing that. We will have an impact of the slowdown in capital inflows. Remember that we are still a current account deficit country, so if global capital flows are de-risking, there will be a growth impact on our economy. And also remember that our critical services sector has not yet started to slow down. Remember that US unemployment is still at only 3.5%, and it is reasonable to assume that unemployment there will go up, and that will also be another headwind to the economy. So we need to close our balance of payments deficit. We also will be affected by the interest rates that we have been hiking for the last 4 or 5 months. And so I think the economy will slow from here, right? Okay. The point we make in a note published today is that it is slowing from a much higher level than had been feared, and we should be able to hold on to a 7% growth rate.
How will it mean, earnings will pan out? The numbers I read for Nifty EPS is something like, 870, 815, 820 thereabouts, which is indicating more a 10-11% EPS growth for FY23. What are your numbers, and what would you look forward to in FY24 in terms of corporate earnings, whatever measure you want to use?
If I may say so, I don't think FY23 matters, other than for the market, that is, other than possibly setting a base for FY24. Because remember that when you're buying the market, or at least when I think about or advise people on whether to buy the market or not, you are buying for at least 12 months, right? You're not, there are people who make money on day trading. I don't think I have that skill. So I would rather look at, if I buy Nifty at 17,000, where will I be on price to earnings 1 year out? And I think that the 1 year out price to earnings is very likely to be sub 17. So as we think about 12-month forward earnings in September, October next year, we'll have half a year of FY24, half a year of FY25. I know it looks really far out and almost unforecastable, but you know what? That is what will drive the market. I mean, how FY24 and 25 earnings move, and I think that the 12-month forward, as we are sitting in September, October next year, will be upwards of 1,000, and therefore I think that and there is a fair degree of resilience there. So if you see the very early season, early result season right now, but bank earnings are going up.
Absolutely.
And the incremental EPS financials matter a lot.
Isn't it time then to buy PSU Banks? Would the alpha lie there?
I have some sympathy for that argument. We've been positive PSU banks and overweight PSU banks for a while now, but I'm still apprehensive, and perhaps this is why sometimes age can be a deterrent of going too far down the quality curve among PSU banks.
Okay.
So we have a few PSU banks in our, in the recommended list, and one in our model portfolio. So no, I think that at least the good quality ones we should definitely consider. The ones who are outside the say top 2, 3 in terms of return on assets and past track record, I would still be a bit cautious on though, but I can see why some people would find them interesting.
Wishing a very happy Diwali and a prosperous New Year's to watchers of CNBC TV18.